So I'm going to talk to you about Matchtech, but what I wanted to do first was really just to give you a bit of an overview of what I think the recruitment market's looking like, because I think it's actually helping investors understand which stocks to pick in the human capital sector. So I'm seeing the recruitment market split very much into two camps. You've got the generalists, and what I mean by the generalists tends to be your high volume, low margin, commoditized recruitment, where finding people really isn't the key. It's actually how you then just transact that commodity. And you can really see the major players in that would be your large corporates, so your Randstads, your Manpowers, your Hayes. But probably your best in class in this sector would be an outfit called Staffline. You've probably seen them yourself. They've, again, like ourselves, has had a really, really strong share price performance over the last 12 months. Where Matchtech fit is very much on the right-hand side. We're a specialist recruiter. We're very, very niche. Our job is to fill very, very hard to fill roles. So our clients tend to like us, which is quite unusual in the recruitment sector. We're normally known as a necessary evil, but in our space, actually, we're seen as a partner working hand in hand with HR. The types of people we place are very niche, as I mentioned earlier. The guys we place tend to operate their own limited company. They are professional contractors, so these are not temps. So it's a very, very different space, and because of that, we can charge a slightly higher premium pricing model for the types of service that we offer to our client base. So that's really where the market is going. And I suppose if you looked at the specialists who are in there, you've got your Michael Page, you've got your S3, you've got your Rob Waters. But obviously I would say the best in class is Matchtech in that specialist space. But obviously I'm biased on that one. There are also some organisations yet who haven't made their minds up, whether they're a generalist or whether they're a specialist. And I think in the next year or two they will be the sort of casualties. They'll be the equivalent of your HMVs and your Jeffsips in the recruitment world. So moving on, structure of the group. Well, Matchtech was established back in 1984, so next year it'll be 30 years of trading. We floated on AIM in October 2006, so we've been on the market a long time. I've been chief exec since 2007, and certainly for the first 18 months I thought this was quite an easy gig being chief exec of a recruitment business. There we are, we took the share price from £3 to 10, and I think by sort of July, August 2008 we were just shy of £5, and we all know what happened after that. So that's when I certainly learnt to find out a bit more about what the job of a chief exec of a recruitment company was about. Now the organisation now is very different than it was in 2008. We took the decision then to diversify the business, and it was quite an ideal time to do it because we had a management team that were very open to change during that period. So we've introduced the group. We've got 400 staff now, based across 8 offices. We have 3 in Hampshire, 3 in London, 1 in Stuttgart and 1 in Aberdeen. Of the 400 staff, we've got 100 of those are what we call shared services. So these are the guys that provide the IT support, the financial support, HR, legal, marketing, bids. So it's a central function that provides that across the brands. Underneath that, we've got 2 separate business units. You've got engineering and professional services. Now engineering generates 60% of the group's NFI and professional services 40%. Now engineering is really where we've come from. Back in '84, that's where we were. And that's represented by the Matchtech brand. And they operate in 6 key sectors, and I'll go through a little bit later the details of what that looks like. We've also then got the professional services area. So this is the area that really has been created since sort of 2011, where we're operating with Connectus and Provanus, our technology brands. Now Provanus is the company that Hannah alluded to that we acquired just 2 weeks ago. We paid £4 million for a very niche Oracle recruitment business that generate 2.1 million of NFI per year. The logic behind the acquisition was very simple. We've been asked on a number of occasions, what is our acquisitive nature? And we've always said to the city that it would be a contract recruitment business that operated in either an engineering or a technology niche, that delivered high margins, and was of a relatively small size, because all of our growth up until this point has been organic. So Pravana's ticked all the boxes. So it'll be very interesting to see how that plays out over the next 12 months. We've also got a professional staffing brand called Barclay Mead and an employability and skills brand called Alderwood. Now what I want to do is just go through and give you a bit of a window into the markets in which we operate. As I said earlier, Matchtech, our engineering brand, is our most established. It's been going 30 years. And it operates in these 6 key sectors, so infrastructure, energy, aerospace, automotive, marine and science. So in the infrastructure world, our key clients are all of the consultant engineers. You know, your Atkins, your URS, your Mouchel's. Mouchel's not been a great one for us, but we've managed it all the way through. That's been great. And you've got White Young Green, WSP, so all of these organisations. And we're not just recruiting for them for UK infrastructure programs, we're recruiting in the UK for engineers that are actually involved with infrastructure programs across the world. So that area has been very good for us and is continuing to grow, and it's our largest area within engineering that we support. But we get very involved very much on the white collar side of it. We're not into sort of blue collar recruitment within that sector. In energy, it's very much in the oil and gas sector. Unfortunately not in Colombia, it tends to be mainly in the North Sea. And I think our most dangerous territory is Leatherhead, that we put contractors in. And most of our contractors again are white collar, so these are design-based guys that are involved with deep sea drilling and are working for EPC contractors. So again, these are not guys working offshore. In the aerospace sector, we basically deal with all of the Airbus and Boeing supply chain, and it's all commercial aerospace. And the UK is the centre of excellence for wing design, and if you're looking at most of the operators now are looking to reduce their fuel loads, and the only way you're going to do that is by looking at different materials. So again, there's a lot of research and a lot of work going involved in that area, which is creating opportunities for us. The automotive industry has probably been the one that's been the standout sector over the last 18 months. I don't know if we got lucky with our business development strategy, but we managed to hook up with 3 quite useful organisations in Jaguar Land Rover, Aston Martin and McLaren. So we're very much at the high-end automotive side of things. So for us, it's the global demand for those products is creating opportunities for engineers in the UK. On marine, well, there's only 2 clients in marine. You either work for Babcock or BAE, and that's it. So that's about it. And we do work with both, and we've had a very long relationship with both those organisations over the years. And we've been merrily building the 2 aircraft carriers that probably won't see operation for another 10 or 15 years, but we're building them. And then on the science and medical side of things, it's very much in the biotech and pharmaceutical world of things. And again, if you looked at Matchtech, the engineering business, its split is 75% of our profit is generated through contract recruitment. And as I said earlier, these are professional limited company contractors, and 25% of the profit is generated permanent fees. Then on to the technology side of things. Now, our technology brand Connectors used to be within Matchtech, but we spun it out in April this year. Just want to give you a little bit of logic why we did that. What we've seen in the technology space is very much what we classify as a convergence of technology. In the old days, IT used to be just business application software. Nowadays, IT and technology is very different. You know, I mentioned Jaguar Land Rover. We're putting more people into Jaguar Land Rover on the technology side than we are on the engineering side, because it's all about engineering control systems. And the really interesting thing for us is that the candidate community in IT used to be very much separate from that of engineering. But because of this convergence of technology, that candidate database now is becoming more transferable. So, for example, we can put a contractor in at BAE doing a cyber defence project. That contractor can finish and then go and work for Citigroup on a fraud program. It's exactly the same technology, but very, very different industries. So now, because we've come up through the engineering route, we've got a very different candidate base to offer that client than maybe our competitor like an S3 would. So that's given us some market share, and that was the whole logic of spinning Connectors out of Matchtech. We also, and with Connectus, we wanted to enhance our capability in ERP, and again, that was a reason why we bought Provanis. You know, they're very, very niche in the Oracle market, so we now got a much, much greater capability within the ERP space. Again, the business dynamics of this area is very different from Matchtech. It's 50% contract, 50% perm. Now, if you look at how the market is recovering, and it's predominantly going to be perm recovery, there's great scope to increase the revenue lines in this area. Professional staffing, well, we chose to go into this sector really for its strategic candidates, because in professional staffing, you are dealing with an HR manager, a finance director, and one day they can be your candidate and the next day they can be your client. So this is a real strategic group of individuals. So being able to place candidates within procurement, within HR, within finance and within human resources is a real good business development tool for us. And again, this sector is very perm focused. 70% of the profit we generate from Berkeley Media through permanent placements, and 30% contract. And when I say contract, it tends to be more interim appointments. And then finally, Alderwood Education, or Alderwood. This is a very high volume, permanent recruitment business. It's got low fees. This is the business that actually places the assessors for your apprentice program. So the increase in investment into apprenticeship programs in the UK over the last couple of years has fueled the growth for Alderwood. You know, we're placing over 600 people in the last 12 months, and certainly the level of media coverage with regards to the apprenticeship program, I can only see this continuing. And for once, Labour actually said something I was quite pleased about, because they were talking about for every immigrant they bring in, they'd have another apprenticeship. So I thought this is going to be good news for Alderwood if they actually come across on this. But we do see this as an area of high growth. But recruitment people are good at talking things up. So I thought I would give you some growth opportunities from some sort of third-party references. So we've got. There we go. We've got our governing body, the REC, and for those who like to read their report was out 2 weeks ago, and you can see that temp billing is at its highest level now for 15 years. Also in that report is that perm recruitment has increased at its sharpest level for the last 6 years. So the sector that we operate in is starting to move. You've also got the CBI talking about infrastructure. The CBI reported that quality infrastructure is critical for boosting exports and unlocking investment across the UK. This is a core area for us, so continued investment by government in this sector will fuel growth for us. Now this is the scary one. Engineering UK. They reported between 2010 and 2020 a further 1.86 million engineering jobs need to be created to be able to sustain the demand of this country. That's a huge number, huge number. And the apprenticeship programs I talked about earlier, that's going to take a while for that to come through. So the skill shortage that we're seeing within engineering and technology will continue. Now, I think if that continues, that's all that's going to do is reinforce that organisations like Jaguar Land Rover, BAE will continue to need organisations like Matchtech. So I've got my own little ditty. I've been in the industry now for 25 years. And the good thing is that we're starting to see candidate confidence return. Now, that candidate confidence is great because certainly for permanent recruitment, there needs to be a natural churn in the labour market. And then over the last 5 years, that churn has been subdued because you've got candidates who are in employment thinking, do I change jobs or not? It's got to a point now where a lot of candidates have not had a pay rise for 2 or 3 years. And they think, well, I want to improve my personal situation. So we're starting to see that logjam come through, and we're starting to see the labour market churn. And already in certain sectors, we're seeing pay rate inflation. Automotive and oil and gas, pay rate inflation is already over 5%. And pay rate inflation for us is fantastic. So we're operating on a fixed percentage margin for one of our key clients, we may not be able to change that percentage margin for maybe a year or two, but an increase in pay rates will generate additional profits for us. So that's how I'm seeing things. So I'm going to pass you over to Tony Dyer, CFO.
Thank you, Adrian. It's nice to see a chief exec that's keen to get his picture off of the screen. When we talk to investors, we always talk about this being our favourite slide. When we listed in 2006 on the market, we told investors that we're a resilient contract recruitment business, and we think this slide is different to the profile of a lot of recruitment businesses when they enter into a recession. As you can see, the revenue has been largely unaffected. The NFI has dipped, and as you can imagine, we were under margin pressure from our larger clients through the recession, and obviously permanent placements did take a dip. I think the key figure on this slide is at the bottom, which is our NFI conversion ratio. As you can see, in 2008 we peaked at 42%. That has dipped. It is now on the increase, and although the structure of the business has changed, so it will never return to the 42% when we're a single site business. We are looking to get that into probably the mid-30s. And the pleasing thing, you can see the level of growth trajectory is on the same curve as it was pre-recession. So if you map that going forward, and we can produce the efficiencies and get the NFI conversion ratio through, you can see what effect that will have on profits going forward. So to sort of explain a little bit more what's happened on the two sides of our business, as Adrian said, we're 67-70% contract-driven business, and the blue bars are the numbers of contractors we have on assignment through the recessionary period. And as you can see, they continue to grow through that period. So it's proved how resilient it is. Big infrastructure projects do not go away when a recession comes along. They're long-term projects and they need to be finished. So, we are still growing contractor numbers. We were 7,100 at the end of this year, and we foresee that the demand to continue on that. The permanent side, you can see we did take a bigger dip in the recession 2009 and 2010. We've now returned to the levels that we were pre-recessionary. They've been relatively stable for about 2 years, but we are now seeing an increase. Confidence is returning, and we do see as that confidence of candidates and clients returns, we should see that accelerate as we go forward. So, investment proposition. We're a well-balanced business. We've got a broad relationship, wide client relationships and business mix. I think we invoice 1,200 clients a year. Strong track record of organic NFI and profit growth. Specialist, so we're niche sectors, so we're always going to be in demand. We're operationally efficient, but there's still some work to do to get more of those efficiencies through. And in the coming year, we're going to be investing more in our technology systems to leverage that further. As I say, it's a resilient contract business model. We've got committed funding facilities of 50 million. Net debt at the end of the year was 10.5 million. So we've got plenty of capacity in our facilities. You might like to say, why have we got such high facilities? Well, as a contract-driven recruitment business, there is a working capital need, and if we do accelerate growth, then it gives us plenty of capacity to grow fast within those facilities. We've been around a long time. We are skilled. We're big enough that we can take market share from our competitors. Internationally expanding into selected markets, but we're doing it in a controlled, low-risk way. We're not going out and setting up in, like some other recruitment businesses, when they report their results, they're talking about how many offices they've opened. We'll only go into markets where we know we've got a relationship to enter into it, so those markets are profitable from the start. And we've got a solid dividend payout record. We've maintained our dividend through the recession, and we are heading towards the point where hopefully we can start progressing that dividend again. But we are a solid yielding stock. I think it's yielding 3.7%. If I return to that, our favourite chart, because I'm not going back to it, I've just progressed that. That's consensus analyst forecast. Our results are out in a month's time, so obviously I can't tell you what they're going to be, but that's what's in the market at the moment.